Today, we're going to talk about something important: why you should invest. Investing isn't just about saving for your future. It's about being smart with your money and making it work for you. There are countless reasons to start investing, but we'll focus on the most basic and important ones today. Let's start with a simple question. Do you work for money, or does money work for you? If you can answer this question, congratulations. You're already ahead of many people when it comes to understanding the basics of investing. Most people spend their lives working hard to earn money and then spending that money on daily needs. The money comes in as income and goes out as expenses, a never-ending cycle that continues until retirement. But here's the thing: you don't have to stay stuck in this cycle. To break free, you need to make your money work for you, so it can earn even more money. This is where investing comes in. You've probably heard the saying, money attracts money. It's true, investing is one of the easiest and most effective ways to grow the money you've already earned. Let's explore why investing is not just smart, but essential for your future. Let's break down the key reasons why investing should be your new best friend. 1. Beating inflation and outrunning the money thief. Inflation is like a sneaky thief that erodes your money's purchasing power over time. Think about it. What you could buy for $100 10 years ago now costs more than that. Things are getting expensive day by day, making the purchasing power of money low. If you leave your money in a regular savings account, its purchasing power will gradually decrease, much like a person losing strength with age. Even the interest earned from a regular savings account often fails to keep up with inflation, causing your money to lose value over time. But investing? That's like putting on a superhero cape. When you invest, you're buying shares in companies or other assets, where the value of what you hold is determined in real time by market valuation. Unlike savings, investments have the potential to grow and adapt, often outpacing inflation and increasing your purchasing power over time. Imagine you have $10,000. If you put it in a savings account earning an average interest rate of 1% per year, after 10 years, your money would grow to about $11,046. However, with inflation averaging 3% annually, the purchasing power of that money would actually shrink, leaving you with the equivalent of about $8,200 in today's dollars. Now, if you had invested the same $10,000 in the stock market, for example, in an S&P 500 index fund, with an average return of 10% per year, your money would grow to approximately $25,937 after 10 years. Even after accounting for inflation, your purchasing power would still be around $19,400, significantly more than the savings account. This demonstrates how investing can help your money grow and preserve its value over time, while savings accounts often struggle to keep pace with inflation. 2. The compound power of money. Your money's gym membership. When you invest, your earnings generate their own earnings through a magical process called compounding. Picture this. You invest $1,000 and earn a 10% return. You'll have $1,100 after the first year. In the second year, you have $1,100 capital to earn the return, and so on. Over time, this snowball effect can lead to incredible growth. Imagine investing $5,000 at age 25 with an average annual return of 7%. By the time you're 65, without adding any more money, you'd have over $74,000. That's the magic of compounding. 3. Retirement planning. Your future self will thank you. Picture this: you're 65, lounging on a beach, sipping a piña colada. Sounds amazing, right? That dream becomes a lot more achievable when you start investing early for retirement. Think of it as sending care packages to your future self. Each investment is a gift that keeps on giving, ensuring you can enjoy your golden years without financial stress. 4. Wealth creation. Building your financial empire. Wealth creation through investing is like playing Monopoly, but in real life. You start small, maybe with a few stocks or a mutual fund, but over time you can build a diverse portfolio that generates greatest passive income. Remember, every financial empire started with a single dollar. Your journey to wealth creation begins with that first investment. 5. The drawbacks of saving. While saving is essential, it's not without its drawbacks. Money sitting in a savings account is easily accessible and can be tempting to spend. This accessibility can undermine your long-term financial goals. Investments, however, are not as easily liquidated, helping you stay committed to your financial plan. Additionally, savings accounts offer minimal returns, often below 1%, which doesn't help your money grow significantly over time. Why investing has never been easier? Investing today is simpler than ever. With online brokers and mobile apps, you can start investing with just a few clicks. No longer do you need a large sum of money or connections to get started. Everything you need is available right at your fingertips. It's a missed opportunity not to take advantage of these resources. But don't worry if you're just starting. Better late than never. The best time to invest may have been years ago, but the second best time is now. So, why wait? Start your investment journey today and take control of your financial future. So what are the best assets to invest in? There are several exciting options. Stocks, owning a piece of a company. Stocks can offer high returns but come with higher risk. Imagine you invested $1,000 in Amazon, AMZN, in 2015. At that time, Amazon's stock price was about $300 per share. By the end of 2020, Amazon's stock price had surged to around $3,200 per share. Your $1,000 investment would have grown to over $10,600, a significant increase in just 5 years. Bonds loans you give to corporations or governments. They tend to be less risky than stocks but offer lower returns. Suppose you invested $1,000 in a 10-year U.S. Treasury bond in 2015 with a yield of about 2%. By 2020, your investment would have earned approximately $100 in interest. While the returns aren't as high as stocks, bonds provide stability and are a safer investment option. Mutual funds and ETFs. These funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets, offering a balanced approach to investing. Let's say you invested $1,000 in the Vanguard S&P 500 ETF VOO in 2015. The ETF tracks the performance of the S&P 500 index. In 2015, the VOO price was about $180 per share. By the end of 2020, the price had risen to around $350 per share. Your $1,000 investment would have grown to approximately $1,940, almost doubling your money in 5 years. So diversification is key to a balanced investment strategy. By spreading your investments across different assets, you reduce risk and increase the potential for stable returns. The long-term benefits of investing is not just about growing your wealth, it's about securing your future. Long-term investing can help you achieve major life goals, such as buying a home, funding your children's education, and ensuring a comfortable retirement. Moreover, investing can provide a sense of financial security, knowing that your money is working for you and growing over time. So, start your investment journey. Now, whether you're a complete beginner or you've dipped your toes in the investment waters before, there's always room to grow and learn. Remember, investing is not about timing the market, it's about time in the market. Thank you for watching.